All right, like I said, this is going to be recorded and you should be receiving this relatively shortly after this webinar is complete. One thing I always say is watch this again as soon as you can, as soon as you get the opportunity, then at least the next day or so. So this really sinks in. If you wait a month down the road, it's going to be like learning it all over again, especially if this is a new concept to you. Having said that, this is going to be on long butterflies. We've done them on short butterflies. We've even done these on broken wing butterflies, which we've done webinars on that are actually like this, but a little bit more dynamic, and you can actually increase your probability of profits with those. So you can check those out as well. But this is going to be on the long butterfly, and I got to go over a couple of things before we get on to this. My name's Eric Wilkinson. Some of you may recognize me from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from geopolitical to economic and market analysis. And I've been trading my own money for 20 years, well over 20 years now. I actually started out trading in college, went there for a psychology degree and switched it over to finance after I started trading. And after graduating from college, moved to Chicago to work at the Chicago Board of Trade. In that time, I basically traded everything across the board. And I'm not here to tell you that I'm going to make you rich or that I'm going to make you a millionaire, but I am here to help you take control of your finances, manage your portfolio, and most importantly, take control of your own risk. It's something that is lost on some people. At the end of the day, if you have somebody else managing your money, you're paying a lot in commissions and hidden fees, especially even in no-load mutual funds. There's a lot of fees in there. And if you can take control of that, do it yourself, you'll probably make the exact same mistakes as they did, but you're not going to be paying them to make those mistakes. And it's going to overall increase your yield over the course of you doing your own investing. So I highly suggest people do that. And I've traded everything throughout my career. I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all of these products in all market conditions. I do need to go over this disclaimer really quick. Any opinions, news, research, analysis, prices, or other information contained here, or any other material provided by ProTrader Strategies and associated companies or employees is provided as general commentary and does not constitute investment advice or solicitation to buy or sell any of these securities or strategies. Basically, at the end of the day, one disclaimer also is we may be talking about different stocks and strategies that I already have in my account, and I'm not trying to get you to do the exact same thing that I'm doing. I'm just trying to teach you guys different things that you can do. But at the end of the day, you need to do your own homework, and please remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right. This is going to be on the long call butterfly. And like I mentioned, we did do some on this short call and put butterflies and broken wing butterflies. But at the end of the day, what this is really all about is not being a one-trick pony. You need to know what all these different strategies are and know when the right time to implement those is. Don't just always, take your favorite strategy. I mean, I even have my favorite strategies, but at the end of the day, you can't just always implement those same strategies because you're setting yourself up for something disastrous if things start moving counterintuitive to what you were already thinking. JC says the slide hasn't changed. Can you guys see the slides changing? Everybody else? Oh, it from the disclaimer to this. Dominic says yes. David says no. All right, so I'm getting quite a few yeses now. You guys may have to log off and log back on. All right. All right, so we're on to market assumption. Let me see if you guys can see the market assumptions. This market assumption is that it's going to kind of stay in the same place. We're going to have this hopefully pin at our middle strikes that we do. We don't really want it to travel outside of our wings, because outside of our wings, that is going to be where we start incurring our losses. It's actually we're going to start incurring losses slightly before that, but we want this movement to stay inside the wings and within a tight range. So this is a great strategy to take advantage of after implied volatility has expanded. Maybe this has made a big move after an earnings, and then it starts settling down into a range to where the price has been determined to be fair and equitable. So that's where we're kind of looking for that, and then we get the volatility coming down afterwards. And at the end of the day, we're going to be doing this where we're really taking two spreads and putting them together. We're kind of smashing two spreads together, which creates that neutrality. You know, we're going to be doing a short call spread, which would be slightly bearish, and then a long call spread, which is bullish. So those two are going to create this full-on butterfly. And we're going to be doing the short strikes. These two short at-the-money calls are at the same strike. Okay, so you know, you could split hairs on saying two different strikes could be at the money, but these two short calls are going to be the same strike. And then we're going to buy the in-the-money call, and then buy that lower strike that is out of the money to create that overall butterfly. And I'll go into some of the rules a little bit later on how to determine those wings and the base. But this is what the overall butterfly looks like. If you can think of what a butterfly looks like, the reason why it gets its name is because it's kind of got a fat body here, and then it's got the wings that are a little bit thinner there. So that's kind of the idea of the butterfly, because you have two strikes here, one here, and one here. This being in the money, at the money, and out of the money calls. Okay, so that's kind of where that idea comes from the butterfly. All right, then on to the keys to success. The underlying really needs to have a tight bid ask, and I go over these keys to success in every one of my webinars, and one of the most important things is picking the right underlying, making sure that, you know, it is an underlying that has a lot of participation in it. Everybody's heard of Kellogg. A lot of people trade that stock, but in the options, there's just not a whole lot of participation. It's got a pretty wide bid-ask price for the size of the underlying. So Kraft is one of those ones where there's a very rare occurrence where I'm going to enter a trade around that, maybe around earnings, because there becomes a lot more participation in there. But Kraft is one of those where it just doesn't really work with this strategy necessarily because of that wide bid ask. As the more we layer on different legs to a strategy, you have to think about that 20 cents wide on each one of these legs could end up being close to, you know, 60, 80 cents. So that is what we're going to have to kind of really look at going forward. So keep that in mind when you're implementing these different strategies, okay? Oops, I don't want to go to that yet. Meant to hit the, all right, so I'm back on. Moving along. Sorry, guys, I got sidetracked here. And picking the right strikes. So this may seem like it's pretty easy. We're doing the at the money, in the money, out of the money. You know, those should be pretty, maybe even one tick wide, well, or one strike wide. I like to look at it in that if we're doing a $5 wide strategy, we're going to be trying to pay, you know, right around a third the width of those strikes. So on a $5 wide, we're going to be kind of looking to pay less than, say, $1.50, and on a $2.50 wide, less than 80 cents. And yeah, so John was asking, did I mean Kraft or did I mean Kellogg? I actually meant Kellogg if I said Kraft. Kellogg is something that everybody trades and that has a tendency to have wide strikes in the options chain. All right, so picking the right duration. We're going to want to have this be right, and the longer duration we have, the more opportunity we have to be wrong. So in this, we kind of want to pick something less than 35 days because we're trying to pin the strike, and the further out in time we go, the more likely there is going to be some external forces that push that away from us. So I like to go inside that 35 days and get those the extrinsic value of those two short options to really decay quickly for us. So then we get to keep the ones that we bought that were at the money. So we're going to be looking at something that is less than 35 days. When I'm talking about this theta decay, that's what's going to decay. The one that is in the money has extrinsic value, and we want that to decay. So really the value is only in the intrinsic value, which is what the difference between that strike is and what the underlying is trading at. And then our out of the money call, we want that to completely decay away and be worthless, leaving us with those two at the money calls that are the only ones with real value for the most part. All right. And we want volatility to contract. So in this environment, we're going to be looking for a higher than normal volatility. It's going to be hard to find something right now. So I'll show you some different ways to look at volatility in order to make it meet the overall feel for this strategy. And at the end of the day, the reason why we want a higher volatility in this particular one is because it allows us to pay less for this strategy. The higher the volatility increases those premium, increases that extrinsic value in the ones that are in the options, or the in the money options I should say, and the ones that are out of the money are also going to be a little bit more inflated. So when volatility comes out of that, we'll get this decay rather quickly. And then knowing our exit strategy before we enter this trade is extremely important as well. And the thing that I look at for this is I want to get out of this when I have received twice as much as the debit paid. So for example, if we paid 80 cents for it, when this is trading for $1.80, I'm looking to get out of it rather quickly. I'm not looking to get the max profit. I'm not looking to take this all the way to the expiration date to receive that max profit. And the reason being is this is a lower probability trade. So if I can get 2 times that debit I paid as a credit, then basically I'm looking to exit because I've beaten the probabilities. And I also don't want to go into expiration with this because I very well could have my in the money option could very well stay in the money. You know, it'd be nice if it went out of the money, that would be fine, but or actually if it goes out of the money, then we've actually lost the thing, so, or lost our profit potential. We're going to be at a max loss at that point. So keep that in mind. If we're right going into expiration, that into the money option is actually assignable to us, and we don't really want to take that risk on. So keep that in mind. The closer to expiration you get, there's a lot of other risks that are involved with this that you don't really want to participate in. So if we can capture 2 times the debit paid, that's where we're looking to get out. Otherwise, I'm looking, if it immediately starts losing, I'm looking at that debit paid as going to be a max loss. And just keep the dream alive that maybe it comes back into line, and then we can make that max profit potential more of a reality the longer we are doing it. No, I'm sorry. I misspoke for a second there with the, we do not want it to, the in the money option to go out of the money at expiration. We want it to be at the, basically right, the perfect scenario would be it's trading exactly at the price in the future as it is now. So that in the money option should always remain in the money. So, but the closer we get to expiration, that in the money option, because it is short, we are going to have a higher risk of having assignment risk. Does that make sense? So I don't want to have that risk happening the closer we are. So prefer to be in the money at expiration. Yes, I mean, I'm not going to take it that long. The only time I'm taking this strategy into expiration is if it's basically a full loser and I'm just kind of keeping that dream alive. So in that, our in the money option, if the market sold off immediately after we put this strategy on, it's looking like a full loser, and that strike would be out of the money. That would be the only time that I would really leave this strategy on all the way to expiration, because I'm trying to keep that dream alive. It might come back into line and I'll be able to recover some of that. Does that make sense? So the only time I'm really going to do that is if the market really sold off right away, I was completely wrong, all my options are out of the money, looking to expire, worthless. Well, then in that case, there's no reason to really take it off. It's already a defined risk strategy. I'm going to try and keep the dream alive. Yeah, so the market sold off. My short call that is in the money would then be out of the money, looking at a max loss. That would be the time I would keep it on. Now, if the market really spiked up and rallied and all of my options were in the money, then that would be a time that I would be looking to exit that strategy, just because I don't want the assignment risk. Because I could get the deep in the money options has a higher probability of being assigned. I might look to get out of that, cut my losses, and move on. Oh, sorry, max profit. Anytime we're doing this strategy with the long call butterfly, our max profit is going to be the premium we pay. Anytime you pay a debit for a strategy, that is your maximum. That's max loss is, this should be loss. For some reason I have these switched up. So this is a snafu. So max loss is going to be our premium paid. Max loss is the premium paid. We're paying a premium for this strategy always. So the max loss is going to be the premium we paid. And then let me just go to this one. This will be a little bit easier to see. So we're paying a debit for this. This is an example of the butterfly. And as you can see, this is going to be ticker symbol GIS, General Mills. And this was trading right around 70 when I put this together. So the at the money calls are the 70 strike. So we're selling 2 of those. And then the ones that we're buying, yes, are the 67s. Those are the ones that are going to be in the money. And then the 60 or the 72.5s are the ones that are going to be the ones that are out of the, or the 72.5s are the ones that are out of the money. So our max profit is when the underlying is trading right here at 70. You see that? That's where our max profit is if it were to trade there at expiration. Now, we're not looking for that. We're looking for it to get out of this at $1.20, let's say, just for rounding purposes. So if it goes and sells off to 67.5, all of our options are going to be out of the money. So we don't have to worry about this ones that there won't be anything in the money. It's going to decay. All of these options are going to be worthless. What we're looking for in that regard, if it's trading down here close to 20 days to expiration, is that it will rally back up into our sweet spot. If the market rallies above, then these 70 options are going to be in the money. So that's when we're going to be looking to get out of this right away. We don't want it to worry about any assignment risk on those short calls. And the further the market rallies up and the closer to expiration is, the more we're going to have that assignment risk on our short calls. Does that make sense? It may have caused some confusion with some of that stuff, so let's just get into the platform here. And this was the one that I was looking at for the analyze. This is the particular setup. Now it looks as though it rallied a little bit as the day went on since I had put this on, but in that regard, the one that is still closest to at the money are these 70s. So that would be the reason why you would pick that one. They're slightly in the money, but at the end of the day, that's the closest to. If you're more bullish, though, on this particular strategy or on this particular underlying, you could go slightly out of the money and pick that one if you thought in the next couple of days it was going to kind of push higher. How do you get twice the debit? As this increases in value, if you look at, for instance, the strategy that I was looking at, these 67.5 calls have 40 cents in extrinsic value. That's a trader hack as to figure out how much extrinsic value in there. It's not perfect, but it's close enough for argument's sake, and it's a really quick and easy way to look at extrinsic value versus intrinsic value. So as these decay, and these also have some extrinsic value in there decaying as well, this is going to decay a lot more. You can see there's if we do two of these 70s, we're having about $1.80 in decay. This is going to decay by 40, and then the other ones that are just out of the money only can decay by that much. So there's more decay in the ones that we sold than the ones that we bought. You see that? Yes, you are seeing the extrinsic value on the put side. Yes, David, it's a bit of a trader hack that we used to use on the floor a lot. Rather than go through and say, all right, it's trading at $1, it's not usually as easy as this. You can say that really, if you subtract the 70 strike to the 71, there's $1.07 in this call that is intrinsic value, right? The rest of it is extrinsic value. So you could say that there's $1 in extrinsic value. Well, one way to quickly do it, it's not always exact, it may be off by a couple of pennies or whatever, the extrinsic value, you just look over there. And being asked, why don't you just look at the extrinsic value column? That's a good point. You could do that. I just don't do that, and I don't even probably have that on. Oh, I could do that and look at it that way, but I just look at it from the gamma. You could quickly switch back and forth, but it's just as easy to go like this than to click on it. Just glance across and know that my extrinsic value is just right around $1 to me. I mean, if you're looking at 1 or 2 pennies, to me that's, you're splitting hairs, right? So it's just a quick and easy trader hack. If you want to look at the exact price, you can do it by the math, or like Bill was saying, you can just click on the thing. Well, the puts, the further, it's a good question, but the puts get beefed up, they get pumped up a little bit, but at the end of the day, the calls are going, especially the in the money ones, are going to get some of that as well. So like I said, yeah, it's not perfect, and it could be off by, a nickel or something like that, but at the end of the day, when you're doing, the quick and dirty, that's a quick and easy way to do it. If you're not comfortable with that, then, but that's a quick way to look at extrinsic value, is look at the counterpart across the way and see, okay, you know, it's about 20 cents here, you know, it's about probably 25 cents here. And look at the most, you know, look at the highest value. That's usually even closer. So, but anyway, so the ones that we sold have $2, let's say, in extrinsic value. That's $2 of decay. These only have about, the 67.5s only have about 40 cents of decay, and the 72.5s only have about 80 cents of decay. So, you know, we have more decay, a lot more decay in these than we do on the ones that were long. So we want to see that decay happen here, and that's how you could ultimately sell it for more, because those could, and these are going to decay faster also. If you look at the theta decay, the ones that are at the money decay faster. These are going to decay 2 cents a day. These are only going to decay 1 cent a day. That one's only going to decay 1 cent a day. So you know, we have the ones we're long are totally going to add up to decaying 2 cents. These, since we have, or this one, since we have double, is going to decay more. Actually, so that's, sorry, so we're doing this one and this one, so that's 3 cents versus 4 cents. So we're going to get an extra cent of decay because we doubled this one per day. Does that make sense? Yes, correct. Extrinsic is time decay, correct. And decay only happens within the money? No, decay happens with all of them. As you can see, you can look at the theta decay. It happens more the deeper in the money they are, but the theta decay will happen on all of them basically. Further out of the money, it's a lot less, but yeah, you'll get theta decay. Thank you. I'm the man. Kind of fumbled in the beginning there because some of my slides, for some reason, I switched them up. I don't know what happened there, but so this is a better way to explain it anyway. So let's just go through this just like on the Analyze tab. So let's look at this. Let me clear this out. Just get rid of it. I'll be able to get rid of it in a second. So at the end of the day, it's pretty much the same thing. To build this out, you could go up to butterfly and on this drop down here and do butterfly. I always build them out because I don't always like the strikes that they pick. And generally speaking, they're going to make their butterflies the closest strike. And what did we talk about earlier on? Well, we can increase our probabilities of success with this strategy by increasing the width. Right? So you call this a $2.50 wide iron. Yes, this is a $2.50 wide butterfly, because really the width of the butterfly is the width of the one leg. So for this example, we were using this. So you're going to be buying one, right? Then we're going to be control, hold down, and buy the second one. So anytime you're adding on stuff with toss, you hold down the control button and add to it. So then we're going to sell one of those, and we're going to sell the 72.5. We're going to just straddle it, make it $2.50 wide. So this is, oops, I'm going the wrong way. This one is, it's actually better now than it was earlier today, because I must have, why is it coming up as a credit? Because I did the strategy wrong. So we're selling those two, and then we're buying wings. Sorry, stuck on my short call butterfly for some reason. And then we want to, let me just clear this out and start all over. All right, so started out, we're selling the two at the monies, and then we're going to buy the wings for the $2.50. So we're paying a 50-cent debit. So we would want to cover this at about $1.20. All right. Now, we only have $2.50 on either side, a way to increase our probability of success, but remember, every time we're increasing something, we're getting rid of something else. So if we increase our probability of success, we are ultimately going to have to, I'm stuck on buying these, I don't know why. Okay, so we're selling those, we're selling 2 of these, and to increase our probability of success, we go out a little bit further and we'll skip that strike. But you can see we have to pay more, but we're increasing our probability of success. Sorry, you have to pick the wrong one. We increase our probability of success in this regard, but we have to pay more for it. And we're kind of going a little bit over, I said I don't like to pay more than 1/3 the width of the strike. I'd like to pay less than. That kind of clunks that up a little bit. Does that make sense? Yes. Yes, anytime you widen them out, you shorten the apex. Good point. Dominic, did you answer your own question? How do you, I think you answered your own question. In this, the out of the money options are all extrinsic value. All right. So this is usually where I start going into you guys being able to throw out some strategy or some underlyings, and let's look to see if they fit the parameters. It's kind of hard to find them. This is what I was talking about. I think I said Kraft, excuse me, earlier on, but I was meaning Kellogg. 20 cents wide. So how do we pick the right underlying? When I was talking about volume and open interest, you'll be able to see that there is volume and open interest here. Pretty good, but look at this bid ask. It's really 20 cents wide here, 25 cents wide here. I have a rule of thumb. Any stock that's trading under $100 should have the bid ask right here on the at the monies about 10 cents wide. That really gives you an idea as to how much interest there is without having to click over to this. Now, there are a lot of stocks out there that have wide bid asks, like Tesla and things of that nature, but there's a lot of participation in there. And in Tesla, you could probably come in and offer something just a couple cents outside the full widths and get hit on it. There's that much participation in there. But we used to call it like everybody in Tesla is laying in the weeds, or in a market where there was a wide bid ask, but you knew there was a lot of volume and open interest. It was everybody was laying in the weeds. They were kind of like trying to keep their hands close to their chest and not let anything go up. Yeah, so GIS does have low implied volatility. It's hard to find anything right now that really will fit well with this. And potash could be one that has higher volatility. Facebook, I don't think has very high implied volatility right now. And with this, we probably don't need all of these. So let's go to the 14. So 2, I was looking in that example with General Mills. I was really looking for trying to find something that fit the rest of them, and kind of cheated on the implied volatility on that one. You're right. I got busted. All right. So everyone in Tesla is asleep with autopilot. Yes, that's true. It's true. Put your life in the hands of the computer. Monsanto's on here. So this is the high, this is where I put my implied volatility percent right here, and this gives the high ones. So you would like something to be well above 30 on these, and anything that has earnings is something that is in there. We could look at the minors. If you guys look at the junior minors, GDXJ, people are throwing some things out now. So look at Netflix. And the real thing right now is, these have super low implied volatility. So the probabilities are that, implied volatility is going to go up on us, which we really don't want to see. We'd really like to see it come out of it. So let's look at potash because it's got pretty decent implied volatility. So in this, we're going to be wanting to sell the two at the money, 1650. It's splitting hairs. If I was more bullish on this one, for instance, I would probably lean towards the 17s. If I was less bullish, then you might lean towards the 16. If you were thinking it was going to stay right here, but if you thought maybe 17, maybe on some kind of point on the chart was the right place, like in this regard, I would say I would lean towards the 16s because this is where the most time and volume has been spent. That's going to be where it finds comfort. So I would lean towards the 16s, and we're going to sell two of those. And then, we could go to probably $2 wide would be nice if we could. And then $2 to the high side. We're going to be looking at the 18s probably. And it's not really there, so it'd be 60 cents would probably be where I'd be happy with it. So I would probably kick that to the curb because I really don't want it to be $1 wide. As you can see on the chart, it's probably, what's the low, 15 to 18. So that's why I would like to have a little bit more wiggle room on that. Can we use this strategy for earnings plays? And what about weeklies? Yes, you could use this on weeklies if you really like to trade weeklies. That's nice because you can get that real fast theta decay. I would say stay away from using this strategy on earnings. Although you're going to have your highest implied volatility there, the likelihood of you getting your wings outside of the expected move is pretty unlikely. And if you do, then you're going to be paying a huge debit for it. It's just the risk reward isn't there. I would rather see, working around iron condors or strangles, something like that. That's my preferred method for earnings. And I've done a webinar on that, on the rules around implementing those around earnings or the binary event. I do not do straddles 40 days out for earnings. I usually try and go as close to expiration as I can into the weeklies or whatnot, because then you really get a lot. Because what volatility does, you guys, is it holds off theta from theta decay. It really pumps up those premiums and holds off that theta decay. So then when volatility comes out, it's like air coming out of the balloon when you let it go. It's just like and flying around. That's the way a good or somebody pops the balloon and boom, all of that theta and volatility come out at once. So that's why I like to go closer to it, because I like to see it happen. Plus there's more embedded volatility in that option that has the earnings. And another quick trade hack, you can tell where I can look at this options chain and see when potash has earnings, and it's probably right here, in January. I don't know why that's probably, but usually when the volatility increases a lot and then actually it's probably right here in September. Even though it says it's not there, it's going to be, no, they just had it. The volatility increases there. Usually, let's look at something else, like maybe deer. But usually what you'll see happen is the volatility really increases a lot and then will decrease out afterwards. Since they just had earnings, there's still a little bit of volatility pumped into there. So this one's not a very good example for that, but usually you can look and see what volatility increases the most and then starts decreasing. And that would lead me to believe that they've got something going on. Maybe they have a dividend going on in September, and that's why this volatility is pumped up. But you can tell where there's something going on. Can you ever go over twice the debit setting? Yeah, you know, for example, in that one that I had for GIS, you know, we were paying like 50 cents and it was $2. You could, but you know, I look at it as a low probability trade, and how long is it going to stay here, you know? So, you know, your max profit potential on this is, if we look at it, you know, it's basically the width of these strikes minus the debit paid. So it's $2.50 minus the 64 cents is our max profit potential. And given that, it's just, you know, it's like right around $1.90. So, you know, if you followed my rules to thumb, then yeah, your max profit could be $1.90 total. But having said that, your probabilities of it staying right here are not that good. So I would rather just take double that debit paid if I get the opportunity and get out, and not risk it anymore. You know, not risk my 60 cents I already made for another $1 or so. To me, it's not worth it. On the lower probability trades, yeah, get out as soon as you can, right? Sooner the better. And that goes with any strategy that you're collecting, even collecting a credit for, I talk about. You know, I don't take anything into expiration. I don't even like holding strategies for, you know, longer than 2 weeks. If I'm holding a strategy longer than 2 weeks, it's because it's a loser, and I'm just waiting for it to come back or work out. So take your profits quick and reallocate it. You know, go to another high probability trade if you get the opportunity. You know, get in and get out of your strategies quickly, which ultimately increases your probability of success. Okay. Is this better than a debit spread? Yes, this would be, you know, it is a debit spread, but just rather than doing a debit spread, this is a way to take advantage of, you don't want to implement a debit like call or put spread in high implied volatility, because you're setting yourself up to lose money. So this is a way, you know, it's counterintuitive to that. This is, with a butterfly, it's opposite normal rules for the most part. On, you know, a debit, usually you want low IV percent. With a butterfly, you want high IV percent, because you're selling those, the two you're selling have the most extrinsic value. So you want that volatility to come out, which will increase your, you know, the credit that you would receive at the end. Where do I see the probabilities? Is that what you're asking? Where do I see the probabilities in that? Well, the probabilities are is delta. So delta really has a lot of things to say about it. You know, it's, you know, the definition of delta is for every dollar change in the underlying, this, you know, for every dollar change in the underlying, the corresponding strike will increase by its delta. So if potash went up from $16.50 to $17.50, these options would be worth 46 cents-ish, let's just say 46 cents plus this 40-cent delta. So they would be worth 86 cents or so. Okay, that is, you know, the probability of this strike being in the money at expiration is 40% probability of, there's a 40% chance of it being in the money at expiration. That's another little trader hack. And you know, the probability of these 17s being touched is 2 times the probability, which is a floor trader hack. And those aren't all exact and to the money, but those, you know, I come from the floor where, you know, you didn't have time to like pull out your calculator and like punch it in, because usually the first person that gave the quote was the first person to get the trade, right? And so you had to have these like little hacks to get through it quickly. You didn't want to have to like pull, okay, so, you know, times the square root of whatever and pull out your Black-Scholes cheat list and trying to punch everything in there. It doesn't work. So, but these little trader hacks are good. I mean, probability of 17 being touched is twice the delta. The probability of the 17 strike being in the money at expiration is a 40% probability. So it's a low probability trade for one, because you're paying a debit. That makes it a low probability trade. And two, the probabilities of this being a loser are pretty high because of these probabilities of your out of the money being high. Does that make sense? You know, George, we've talked about, if you watch my webinars or my daily market commentaries, George says I should do a webinar on the hand signals for options. And if you watch the daily market commentaries, I try to do the ARB like we used to do it on the floor. Like if I'm buying the 25 calls and selling the 28 calls, I try and ARB it just like we would have done it on the floor. And I use the signal, like what the butterfly looks like when you're, the hand signal for butterfly, the hand signal for strangle, iron condor, all that stuff. Sorry I missed the beginning. Do you view all long symmetrical butterflies as low probability trades? Yes, I do. And that, you know, even the butterfly in general is a low probability trade. And another thing with the frustration of a butterfly is you have to have patience. You know, you heard me talking about I like to get in and out of strategies as quickly as I can. Butterflies like to test patience. They take a little bit longer to get to that end goal. So keep that in mind too. You have to keep these on a little bit longer than normal. Okay. That answer your question there, Todd? Floor trading is a recipe for arthritis. True. Okay, good. Okay, so, you know, because anytime you're dealing with these right around the money, just like, you know, the probability of the strikes that I'm short, you know, are 40% probability of being out of the money at expiration. So that's a pretty high probability also that it could go down. So you got to keep all of those things in mind. How easy is it to close out these trades? Do you usually close out as a whole, or do you usually leg out of them? Great question. When on the floor, I used to leg in and out of these kind of strategies all the time. But keep in mind, I also had an advantage that, you know, I felt quicker than the rest of the market, right? So I also had first right of refusal a lot of times. So those were different things that we would leg in and out of. We could tell when things were getting overbought, and we could lean on other things. So you can't do that anymore. There's too many algos in there. And one thing to do is, you know, even as a floor trader, if somebody asked me for a quote on just one strike, right? My bid ask on just one strike was going to be a little bit wider because I have risk on hedging that particular strategy. So, or that particular leg, I should say. So I would offer wider bid ask because, you know, I looked at that as I'm increasing my risk. I have to, you know, by the time you buy my call, you know, I've got to go and buy that underlying immediately. And in that time of me selling my call and buying that underlying, everybody else is doing it too. So that market's going to rally a little bit. Whereas if somebody said a covered call, I'd be able to give a tighter market because I could lock in the price of the underlying and the call at the same time. I didn't have that external risk going on. So don't do it, is what I'm saying, getting around to. Don't ever leg it. You know, I could tell you that probably 50% of the time you're going to do it right and make a nickel, but there's 50% of the time you're going to do it wrong and you're going to lose a quarter. Okay, so don't leg in and out of these. There's so much going on in all of these that I would just enter it as a strategy, because the counterparty doesn't want the risk and will be willing to give up edge to put it on as a strategy. And you're just taking so many other risks, because if somebody's hitting you on the call, it's auto legging something somewhere else and everything starts moving. So you could really get beat up in the process. So never leg in and out of these things. The only time like I leg in and out of like strangles is if, you know, my one side is just absolutely worth nothing and I might just take that off because all it could do is cost me money. I might take off like one wing or something like that, but you're increasing your risks also in a sense. So my suggestion is, you know, wait till you, it's hard to tell you when the right scenario is to like maybe take a piece of it off. But the easiest one is on a strangle. If I'm getting tested on my puts on the strangle and these calls are worth zero, or I can buy the calls back for a penny, I've increased my risk by a penny because I've decreased my break even. But at the end of the day, if the market does come back my way, those calls could only hurt me. That would be the only time I ever leg out of something, and that would be in a strangle like that. Okay? If you can only buy, you know, because whatever you pay to get out of that leg, you've increased your risk by decreasing your break evens. I hope that I didn't lose anybody there. Yes, commissions can hurt you, and that's something to really take into mind here, for sure. It is going to, the wider you go on your legs, so I'm being asked, is it cheaper to do 4 spreads of 5 points than 1 spread of 20 also? Oh, it is cheaper. Yes, it is cheaper to do it that way, but with that's a different beast, right? But with this one, you know, we're increasing our risk by going further out, or we're increasing our debit paid, but increasing our probability of success. Because remember, we want it to land inside our wings. So if our wings are really wide, then we've increased our probability of landing inside there, but we've also increased our risk in the sense that we've had to pay more and could lose more in that sense. Oh, leg out meaning move the leg. With this one, there's not much adjustment, but yeah, if you you could adjust this if you were able to, like if you had it $3 wide, you could adjust this leg down further and manage that to increase, you know, get more credit, increase your downside break even. Yeah, that's a way you could do this for sure. Is if you were getting tested on your lower wing on these, and these basically were worth, you know, say a nickel, and I could roll those nickels and gain another, you know, 20, 30 cents, then yeah, you could totally do that. Roll it down and increase your break even, or in a sense, you know, lower your break even to the downside there. Great question. Does anybody else have any other questions? Yeah, so Dominique, yeah, so John brought up a great question. So if, for instance, with this strategy, let's say I need to probably have something that has a higher price. Let's just, and Monsanto has really wide bid ask, so I don't want to do that. So anything, so let's just do this one. All right, so they're going to have really wide bid ask. It's a big dollar, so you know we know we're going to be paying a lot for this. But anyway, the closest to the at the money is probably these 15s. So we're going to want to sell 2 of these. So I sold 2 of those and then buy the wings. So let's go with our example. We're not going to go 1 strike right away. So let's just make it a $15 wide just for example purposes, right? And then $15 to the upside would be the 30s. So that would be our strategy. So we're paying $3 for it. So that's right. Did I do that? 15. So so that's inside of our third. That's right there around it. You know, $5 wide, or sorry, $15 wide, $3. That's got to be pretty close to that. So this would be a good example. So now, for example, if this market sold off and went down and started testing these 300s, that would probably be the time that I started initiating some damage control here and collect some more credit. In that, you know, we could assume that, you know, just for argument's sake, that if we went if it went $15 lower, we could look at the strike that's $15 higher than our strike, and that's kind of what ours is going to be worth, right? Maybe a little less because of time decay. Hopefully we got some volatility contraction. But let's say $4. These ones that we are long are worth $4 now. We could probably roll that down to like the 20 strike and gain another $4 or so. You know, so in that I could gain an extra $4 to this strategy, collect $4 credit, because I would be selling out of those ones that are worth less. And actually, no, that's not true. I would actually, I'm thinking of the other way. You would be paying $8 for these. It would be worth $4. You'd have to, no, you would actually be paying more for this strategy. I'm sorry. What I would mean to say is that we would roll these ones that we were short. Sorry about that, you guys. So we would, the only ones you ever want to ever roll are your short strikes. So we would, so if we went $15 lower and it was testing these 30s, we could probably look to roll these short ones that have decayed and gone from $12 to $8. We'd buy them back for around $8. We've captured that $4 decay, roll them down a couple more, and try and collect maybe a couple more dollars on those shorts. Now, by adding an extra couple of dollars to that, you know, we've increased our risk to the upside, because now we're exposed to the upside, right, more. But if it continues to go down, we might have staffed off the bleeding a little bit. Does that make sense? Sorry I started talking about that, but that's the other way around. But the only thing that you would ever roll are your shorts, because those are the ones that have kind of decayed. We wouldn't want to pay more for this strategy. We want to pay less, and the way to pay less is to take those ones that are at the money, roll them down a couple of strikes, collect more credit, and increase our probabilities to the downside. But in doing that, you've increased your risk to the upside. Does that make sense to everybody? That would be the only way to defend that strategy. Take the ones that you're short, roll them down a couple, collect a little bit more credit, and increase your probability of profit. All right. What was it? So did you say hedge your short premium option positions as you did on the floor? But there are so many algos out there that the opportunity left selling premium with an edge. Yeah, so, well, on the floor we had more of an edge because, you know, one, there wasn't algos, but yeah, so, and there's so many participants going on right now that there's these, like, this is really, you know, when I put this into the market, this actually is acting somewhat like an algo. You know, I have this position in there. If somebody came in and lifted the offer on the 15th, this is going to auto leg out, right? So you can't really lean on those 300s, and you don't know you can't lean on those 300s because there's so many other spreads out there that, you know, if I get hit on my 15s, this machine is going to buy the 300 calls and buy the other 330 calls, and it just happens like that. So, you know, if you're leaning on that, it could like completely dissipate in a matter of seconds. So you don't want to try and leg or lean on those things very often. I mean, you'll get eaten up. I'm not saying that you're going to get eaten up every time, but the ones that you lose on are going to hurt more than the ones that make you money. Okay. We paid for the edge on the floor by buying the membership. Yeah. It was facilitating trade. It was before these machines knew how to do it. And before the brokers knew how to do it. All right. So that's the idea there. Try not to leg in and out of it anymore. It just doesn't work. There are still some pits open, but I don't even live in Chicago anymore. It was like it was no reason to live there anymore. Although I do love it. So that's the idea. Pay less than a third. Make sure you know, you have high implied volatility so it contracts for you, are some of the key takeaways. But with this, if you are going to be defending it and rolling down to collect more credit to staff the bleeding, just remember you are increasing your potential for losing money to the upside. And the same thing, if this really rallies up and tests my upper band and I roll it, then to collect more credit, you're increasing your risk to the downside. So, hey, I don't know if any of you guys follow me on Twitter, but I kind of discovered Periscope last night and did an impromptu. We had a lightning storm here, and I thought it was really cool. So I went out there and tried Periscope because Twitter wouldn't let me put a video on there that I had taped of the storm. So I went out there and started doing the Periscope, and for like actually maybe 15 minutes, I was out there like talking to everybody on Periscope. I don't even know what my Periscope is. It somehow showed up on my Twitter blog. So I was just going to video this lightning storm, and everybody recognized me and started saying, hey, Wolfman, what do you think the market's going to do? And so we just kind of had this like impromptu back and forth via Twitter, and because Periscope's owned by Twitter now, it was a Twitter thing. It was really pretty cool. I really enjoyed it. I probably start doing more of that because it's pretty fun. I don't get that interaction with people as much anymore other than in these webinars. But this is my Twitter handle is @Wolfman's blog, so you can follow me there. And during earnings season, like all last earnings season, because I do daily market commentaries in the morning, talk about what I'm going to be looking at for different setups, and you know, when I put them on, when I take them off, what I paid for them, what I take them off for. Talk about all my strategies that I do and why I put them on, what I'm thinking. You know, it's and then for earnings, I threw out a lot of earnings trades, like, hey, I'm putting a strangle on for this, or you know, I'm just selling calls or selling a call spread. And at the end of the day, I don't tell the exact strikes on there. If you've watched the webinars and stuff like that, you know exactly what strikes I'm talking about. So, but I throw that out at the end of the day, and then some other snark that goes on. And you can follow us at ProTraderStrat on Twitter as well. And there's a lot of good, useful stuff that we tweet out through that too. We also, ProTrader Strategies also has a Facebook page that you can click on and go to, but I should find out what my Periscope is. But Twitter handle is Wolfman's blog, and I'm going to send it through I don't know that I'd ever just do Periscope without Twitter. So, so the other thing is we're continuing this volatility crush because I think it's so super important. This, you know, when there's blood in the water and everybody's going crazy right now, the market's really complacent. But when we see this volatility expand, you got to really jump in the water and start fishing, because that is where you're going to, where your year is going to be made or lost. So I talk about how you can look at volatility, when you can determine how it's, or when you can determine how high it is, when you can determine if you should be selling or buying option strategies. You know, it's somebody on the last one, I think we were talking about you know, selling options strategies in low implied volatility, like call spreads and low implied volatility market. But, you know, that being said, or especially even selling a call spread and a low, if the market goes down in big times of big moves like we had, you know, last August, that some people were seeing their calls that they were short increase so much due to volatility that even though you were directionally right that the market was like literally just free falling, you couldn't get out of those call spreads because the volatility was increasing so much. They just weren't gaining value despite the fact that you were completely directionally right. And I talk about all of that and how to combat that in this live course. So anybody who follows me or is a student or even new to this, this is the most important thing to understand. Like, you have to know this like the back of your hand. And by going through this course, you should understand that. It also, more importantly, gives you guys lifetime correspondence with me. So like, you get my email, you guys can reach out to me about anything, like, hey, you know, this strategy is going against me, how should I manage it? I can tell you what I would do. I can't really tell you what I think you should do until I really learn what your risk parameters are and what's in your portfolio. But having said that, you know, we can go back and forth and correspond, and you can run ideas by me, and I can tell you what my rules are around those. So, you know, that is worth it in and of itself. And had you gotten into this before earnings season, you would have easily paid for this in just a couple of trades for the volatility crush stuff. And you're getting it at 50% off right now because you participated in this webinar. So it's a really good one. I can't emphasize enough. We put a lot of work and time and work and energy into making this pretty accessible for everybody. So if you want to trade like a, you know, floor trader or a professional trader, volatility crush is what we talked about on the floor, and how, like, before and after every trading session, we talked about for, you know, a half an hour to an hour before the market opened to after the market opened. All anybody talked about was what was volatility doing, what was making it expand, what was making it contract, what did we expect it to do in the future, because that really determined your overall strategy on the floor, and it really corresponds to what we're doing online. And it is the most important thing to know, and it's one of the harder things to understand. So you got to really get that down pat. So here's your chance, guys, to be a pro trader. Also, you know, you can talk. Tycho might be calling you guys, or you call in, talk to Tycho. Tycho is a good buddy of mine that was on the floor of the board of trade with me, and he's dealt with numerous customers and all kinds of different traders explaining different strategies, because believe it or not, even hedge funds called down on the floor and wouldn't understand a options strategy. And, you know, like guys like Tycho can totally explain that. And if he gets stumped, or if you guys stump him, you know, he'll get you over to me, or you can just even request to get to me also. So so this course is really designed to help you produce consistent winning results for this, you know, for the most part here. So take advantage of that. Oh, so Periscope is the same as my Twitter handle. Good to know. Yeah, you can still trade for 30 years and still get confused occasionally, and that's very true. You know, one thing with these webinars, and I'm trying to think, you know, 2 or 3 steps ahead, and like with this one, I had stuck in my head for some reason, short call butterfly, and kept trying to explain that when I was trying to think ahead. Sorry. I hope everything got worked out in the end there for you guys. Also, so there's a link right there in the chat box to get to this directly, so you can click on that, take advantage of it. And you know, it really will pay for itself, especially if you're a like options buyer and you're paying a debit, and that is like the focus of your trading strategy. Those are low probability trades, and you're going to, you know, maybe hit a home run every once in a while, but all of those ones that you're losing money on really work against you. And like in baseball, you know, selling option strategies, volatility crush, it's small ball, but that's what wins the game. That's what gets you to the, you know, postseason. And that's what we're trying to accomplish here. So, you know, take advantage of that. And take advantage of, you know, corresponding with me afterwards, because I don't think enough people take advantage of that, but you do have full access, and I am quick to respond. All right. All right. That's about all I got, you guys. Later webinars, like I said, we're going to be drilling down on different options components, and how to trade them. Trades I find, when and where I find them appropriate. There's also the link if you want to copy it down, but it's easier just to click on the link right there in the window. And, you know, if you have any questions, you can contact us at 310-598-6677 or email us at trading@protraderstrategies.com. All right. Thanks. Appreciate the comments. How many modules in the course? There is a lot, and I didn't even list all of those. I think there's over 20 of them or something like that. And we're also going to be doing the live volatility crush coming up pretty soon. So there's all kinds of stuff in there, and the history. I think even the history of options is maybe even in this one. And you also get the daily market commentaries, you guys, and that's where I go through daily trades I put on, when I take them off, how I'm defending them, what I see in the markets. I talk about the economic that are going on, talk about all the data points with everything from oil to, you know, even Brexit when we were talking about that. So take advantage of that. All right. That's all I got, guys. If you can't take that, take it easy. Take care and have a great weekend, y'all.